Market watches are big ones for spotting a trend change via the 200 moving day average. Crossing the line can spell a major market shift. But according to my next guest, he thinks they are jumping the gun. One of the toughest charts in the game and former chief investment advisor to Japanese investment fund Ace Capital, it's Lance Lai. Thanks for joining us, Lance.
My pleasure, Peter.
So, I think the most important thing we should say to everyone watching the program now, we're going to make charts easy and we're going to actually understand how these charts can show us where the economy is actually going.
Okay.
And the market as well. So why don't we just kick off straight off and see this chart that you've brought along tonight.
All right.
Okay. So there it is there. The white line is the movement of the stock market over various times. The first hump, that was the dot-com boom and bust, right?
Correct.
And the second one there is the recent boom and the recent bust.
That's right.
And the red line is the critical line. Tell us about the red line.
The red line is the 200-day moving average. And what that is basically the closing price for the past 200 days added together and divided by 200. Hence
the word average.
Correct.
Okay. So what's so important about this average of where the market closed?
Well, it removes the volatility that we see from a day-to-day basis. And what it seeks to do is identify a major change in the trend, to identify that, in fact, the markets have stopped going down, or in fact, the markets have stopped going up. The other state is, of course, if a market simply goes sideways and the line that we have is going sideways and it changes direction.
Now, the reason why you're on the program is that you don't think there's enough evidence in the charts to be totally convinced that this is the start of a bull market. So why don't you, rather than using, and we'll go back to the chart in a second, but rather than just using the charts, tell us why you don't think we're in a bull market yet.
All right. When this market fell over and it began to fall over...
around October 2007,
around
November.
October 2000.
Yeah.
2007. Between the time that the moving average at that time was still pointing up, and it took about a year before it actually began to turn down. And in that year it crossed 25 times. In the upward move, after the 9/11 attacks and then the market bottomed out, between the move up, which was in point 7 of my chart, but in March of 2003, up until the peak, there was a middle part which actually the moving average was crossed 25 times.
Okay, now I might let our listeners, our viewers astray by actually talking about 2007. You're using what happened after 2000, the September 11 problem.
Correct.
To say that there was a change in market direction.
That's
and
right.
there were lots of crosses across this moving average.
That's right.
And then the market took off after that. Okay.
And at the moment, we've really only crossed 3 times.
Okay, so in this current situation,
Correct.
we've only crossed 3 times, and you think that's insufficient to prove that we're in an upward trend?
Unlikely. And also, very much the moving averages, there's a lot of talk about crossing of moving averages, and crossing is really just the start of it. You've got to really see it cross a number of times, or for the price action to be quite a fair bit above the moving average, so that this moving average can turn. Now, the 200-day moving average means that there's basically 10 months of data in there, and so for that to turn around, you need a good solid 10 months of basing action, bottoming action, for this average to be changed from pointing down to sideways and then up. Okay,
let's get the chart back on the screen again. And while we're waiting for that, Lance, why don't you just quickly explain to us, because a lot of the analysts actually look at the 50-day moving average, don't they? Now, why don't you think that as a reliable indicator of where the market's going?
There's a fine line between 50-day or whether you use a shorter moving average or a longer moving average. I mean, a shorter moving average will obviously get you into a particular trade early, but also can have more false signals. A 200-day moving average is a longer moving average. So you could say that okay, you're going to be a little bit late, but when you do see that change, then it's probably the real McCoy.
And it's very important for long-term investors to have that confidence that we actually won't go past those March lows. So your scenario says it's possible that we might go past those March lows.
It's actually too early to say that we won't, I feel.
Yeah.
I think that between now and, well, basically since the March lows and now, we've had a market that's run 43%. This is in the US. We've had it run 43.5%. That's a very large, that's a huge move. And in order for this market to show that it has in fact bottomed, you need to see some squiggles on the bottom, just like we did there on point 7 of the chart.
Okay, so if you look at number 7 you put in there, there's a whole lot of crossings, you're saying, of the moving day average before the market started going up across 03, 04, 05, the boom ahead of our last bust. Now, if we go to the right to the extreme edge of the chart,
yep.
and that red line has currently only been crossed once, is that right?
3 times.
So it has been crossed 3 times.
We're currently sitting above the 200-day moving average.
Yeah.
On the 1st of June, it actually crossed above it. We saw the US hit the peak of 956. It since came off, went through it again, and then now we're back above it.
So people who want to visualise what you're talking about, if that red line wasn't still pointing down,
that's right.
you'd be here with a different argument.
Well, certainly it would then look very much like point 1 on the chart there, where you've got a pointing of upward direction of the chart.
So you're going right to the other extreme where the chart starts. You can see there's a whole lot of crossings there, and bang, off comes a boom.
Exactly.
So what you're saying is at the moment you can't see any ingredients, in a sense, or a market signals saying that an uptrend is well and truly in place.
I think I can see ingredients, but I suppose it's just the beginnings.
Yeah.
And I think
it's not a cake at this stage.
It's not a cake yet.
That's right. Okay. Now, but also, Lance, is your technical analysis supported by other economic or market information that actually supports your case?
Well, 2 days ago, the Bank for International Settlements put out their annual report, and as you know, that bank is the central bank's central bank. There's 55 central banks that have put money in with this central bank.
So if anything is wrong with the banks of the world, these guys should know.
Hopefully.
Hopefully.
And that report that came out was quite, I wouldn't say scathing, but it was very cautious. It basically said that, okay, we've had a lowering of interest rates between post-September 11 up until the middle of 2005. This caused a boom in activity. There was widespread consumption worldwide. They talked about imbalances worldwide. And then off we came with all these systemic problems, they called it.
And you've got a chart, a series of points which actually show what the bank has said. Have we got that there, guys? Okay. And maybe we can talk to those particular points as well. Okay, so let's go to the second one. So the first one was, they talked about interest rates. What else did the bank say?
Well, they basically said that at the moment we're back at very low interest rates again. There's obviously a stimulus in place, and they're cautious that is this just a short-term effect? Yeah. I mean, they wrote in their conclusion, and I'll read it to you here.
Go for it.
It says, "An open question as of this writing is whether the expansionary set of policies enacted in response to the sharp contraction will succeed. A major cause for concern is the limited progress in addressing the underlying problems in the financial sector, a precondition for sustained recovery." So they said there is concern that there's been limited progress, and the progress that they were looking for was to force the banking system to take losses. They felt, well, they didn't say, but when I read that, I thought, gee, they've allowed mark-to-market accounting to be scrapped. Yeah. That's not forcing them to take losses.
They haven't dealt with their toxic assets, have they?
Well, that's coming around.